And that's not just a US phenomenon. The first slide that's slightly blurred, but it goes back to '08. And then we know it has been a global problem as well. And that equally bond spreads have been quite subdued. And that factor of bond spreads being subdued and the suggestion that there is kind of quite an optimism among bond investors around the credit worthiness of the high yield and investment grade segment is actually causing some nerves at this point, suggestion that could things actually be this good? The nerves are being caused on the corporate side. We can see that on the government side, and we still have 30-year yields surging, suggesting that the confidence in government is something different entirely. As a long-term CIO and I think expert in the fixed income space, what do you make of these two kind of parallel stories, which are sort of sending mixed messages?
Nominals are normalised and credit spreads are tight. We're due a good recession, as they say. And interestingly, once everything's tanked, that's when the real money gets made.
And your sense as to why the bond investors are so positive and driving yields down, yet on their
I
other hand have no confidence in the long term?
honestly have no idea. Probably insurance, supply and demand, people hiding out. It might be they've had a diet of short-term money, not making it too much, but they're nervous about longer term and don't want it to back up further. I think there's a sentiment view that, we've more to go. So let's clip it for my time horizon. I'm happy to keep that percentage, accepting I want optionality on the upside. Be interesting to see the swaption rate.
Mm. And
But
then
go on.
no, no. Then the other issue is on the private debt market. We've spoken of this before. It seems to be getting more and more airtime. The First Brands bankruptcy filing debacle. I think a little bit because of this trade claims area, which had been seen as relatively, I say, bulletproof and certainly seen as a safe, especially when the counterparties were Walmart and other reputable, credit-worthy counterparties. The fact that there seems to have been a vanishing of around 2 billion of creditor claims seems to suggest certainly a murkiness in the accounts at best,
Mm.
as well as many other high-profile institutions being kind of affected by this. So I suppose that the question is alarm bells or or not, false alarm, whether this is a sign of some deeper cracks in the 3 trillion plus private credit market, a sign certainly of I'd say less than perfect due diligence and less than accurate.
It's easy to get distracted with a shiny, such a big blow up. Someone once said to me, I always remember this, in the US, bankruptcy is not necessarily that bad a thing, right? Because you can restructure, refi, and work your way through and come out in some sort of condition. And I think, notwithstanding that comment, we are due. We haven't had a proper period of distress for quite a while because the last few sell-offs were bailout, and you've a generation of people coming through who've never seen a proper recession yet because the government always sets in, it always bounces back, even big sell-offs. We saw the war, the wars that have broken out, geez, and somebody, sorry, the Ukraine one's a good example. It tanked, and you're like, okay, this might be the sell-off we sort of. Oh no, it bounced right back. Like it hadn't even been started, let alone halfway through, let alone the beginning of the end of the. And it's just, oh, it's just another major disaster. It'll be fine. And I found that remarkable at the time and find it remarkable today. So what will it take to break the markets right now? Because I'm pretty certain we're due.
Well, I mean, suppose we could look at the default rates. They are trending upwards. If the
Mm.
2025 default rate through August is the same as that the entire year 24, that at least suggests it's trending at a third higher. So that's something, I suppose. And there's a lot more money exposed to private credit today.
There
Um,
was a sea of it, wasn't there? There was an absolute sea of money chasing private credit, and a lot of it was going into vanilla stuff, keeping potentially the rates you're getting paid for implicit implied default rates as not as attractive as it might be. But I think people get wooed in by the numbers and the recent memory track record and think this is a great idea. But I'd be very selective personally in exactly what sort of credit you're getting into.